Hey, Nicole. Thanks again for being on with us, giving us some of your great advice. Really appreciate it.
Yeah, so we have Nicole. She's with Fairway Mortgage Lending, one of our partners in business, and she's one of our data geeks that
Right.
he really digs deep into the statistics of the economy and the housing market as well. So we thank you all for you joining us today.
Yeah,
Yeah. No, lovely.
we really rely on you for a lot of great information. So you always seem to be up on the latest trends, up on the latest information, everything that's changing day to day and hour to hour. So one of the big things I think that's been on people's minds is the forbearance, the mortgage forbearance. So I know when we were chatting yesterday, you'd mentioned there was several ways that these mortgage servicers are implementing this, and I think it was really great information. I'd love for you to share what you can about this.
Yeah.
Yeah.
I mean, so everybody's hearing about the forbearance right now and they want to jump on it, right? And there are people that really need it. And it's there in place for those in dire need, but it also doesn't require any verification or validation. So it's simply a certification. You attest to the fact that you are being impacted by COVID. So that attestation is very simple to do through your servicer. I am losing my voice before I even get started talking. That's a good thing this morning. So that attestation has made it very simple for people to call up their servicer and simply say, hey, I'm being affected by COVID. I want to stop making my mortgage payment. What's not being addressed is what's the after effect. So let's talk about why you'd want to or why you wouldn't want to do this. So if you have a mortgage today, you can call up your servicer, and it's absolutely required that you call up your servicer. You can't just stop making a mortgage payment, because some people think that. They're like, okay, well, during this time where they're allowing it, I just stop making my mortgage payment and I'll automatically be in this program. That's not true. So you have to absolutely get an approval from your servicer, because it's important that they determine who your investor is. It has to be Fannie Mae, Freddie Mac, the two conventional lenders, or FHA, VA, USDA. Anybody else is not included. So jumbo loans, non-QM loans, portfolio loans are not included in this.
Okay.
So first you have to call your servicer, then you have to find out what your options are. So most servicers are offering 90 days forbearance. What that means is I can skip April, May, and June, but then in July, all 4 months are due.
Okay.
So forbearance just simply delays the inevitable. It delays those payments until which point in time the forbearance is over, and then all missed payments are due at that singular time. That's going to hurt a lot of people when that happens. So we have to know that that's coming, and it could cause a whole nother string of issues 4 months from now.
Go ahead.
Listen,
What will that do to people's credit score? Does that have any effect, Nicole?
So it could, right? So credit scores during the period of forbearance, it is not supposed to negatively impact your credit score. It's not supposed to be, no lender is supposed to actually update your credit report at all. So therein lies another issue to say, okay, so it's not negatively being reported, but it's not even being reported that you have a mortgage payment. So a year from now, if I want to refinance, there are already servicers or lenders that are saying that if people miss their mortgage payments during this time now, they might or might not consider that as a compensating factor into not doing their refinance down the road, because that was somebody that could not manage their mortgage. It's a risk factor, one that's going to have to be taken into consideration on the next refinance or purchase. We don't know how all that's lining up, because the cart went way before the horse in this one. They put it out and then they're trying to figure out how to make it work, which is kind of hurting all of us. But so to go back on that 4th month, if you call back after your 90 days, and you'll need to re-engage with your servicer, it's on you, the borrower. You can either make all your 4 payments, or you can call them back and say, I need an extension, or I need an alternative solution. They have the ability to extend you up to 180 days and then up to an additional 180 days. So it could theoretically go a whole year based on the law that was passed a week ago now.
Okay.
But at that time, so when you call after the 90 days, you have a couple of options. You can either do a second forbearance for another 90 days, just kicking the can further down the road, or you can do a deferment, which literally means taking that money's, moving it to the end of your loan. You will pay interest on that money. It's just adding the principal, and it will act like a balloon payment at the end. It doesn't stretch out. Now, instead of 360, I don't have 370 months of payments or 365. I just have this lump sum that's due all at the end. That's a deferment.
Well,
The other
will most of the lenders offer a deferment, or most of the servicers offer a deferment, or is that something that's case by case basis?
It is going to be a case by case basis. Yeah, none of this is absolute.
Okay.
Fannie Mae came out with a letter after the bill, because the bill primarily focused on Fannie Mae and Freddie Mac. I'm sorry, FHA came out with a letter after the fact saying that they were also agreeing to the 180 days with the 180-day extension.
Okay.
But neither one of them necessarily said that a deferment is required.
Okay.
It's just, so they'll have the option to do a deferment, or they can do a loan modification, which is, we've all heard of loan modifications. They've been around forever. You can apply for one. And in that case, it will absolutely affect your credit. You more than likely will have to show late payments, and they will readjust your terms accordingly. And that's a negotiation that you have with your servicer. So those, and then the last one is strictly for FHA. They're allowing a secretary's lien, and that's a second lien that is not going to have interest associated with it. That's going to sit on top of the primary, and that's for the past due that will be paid off when you either refinance or purchase. So it kind of acts like a deferment, but it's FHA specific, and it doesn't have interest attached to it.
So that's a really great option then if somebody does have an FHA loan and they can't make their mortgage payments. That seems like
it is. It's certainly something that I would ask about, to say,
yeah.
hey, what would it take to get a secretary's lien?
Mm-hmm. Yeah.
That's awesome.
No, that's great.
So Nicole, can you just talk to us a little bit about first-time home buyers and kind of, the process they should be taking right now, or the steps they should be taking right now, and talk to us about if there's any assistance out there for first-time home buyers.
So all of the down payment assistance programs are still open, right? So CHAP is still open, MMA is still open. But what we're finding is most lenders aren't allowing loans to be originated using down payment assistance. Because I've had that question. They're like, but I called CHAPA and they said that they were still open. Well, they are. But any of the down payment assistance programs have contracts associated with taking loans. So if I originate a CHAPA loan and I go sell it to CHAPA, they'll take that loan, but it has stipulations. One of the stipulations is that there's a period of time, and it depends on the down payment assistance program, but there's a period of time where they say, if a borrower misses a payment during this period of time, you, the lender that originated the loan, has to buy it back.
Oh, wow.
That's huge. I mean, that's beyond huge. So what happens is we originate a loan that we think is all good, and we've helped the borrower and they've gotten their money and we sold it to CHAPA, and 2 months down the road right now, they choose to forbear their payments. That's a loan that's technically in default, even though it's not hitting your credit report. That CHAPA or whatever down payment assistance is going to kick that loan back to the originator, and that we just can't, we're not built to take them back. That's not our job. We originate them and we move them forward.
Right.
So to have to take them back, it puts a huge strain on the lender, on their warehouse line, on their ability to continue to originate and everything else, and high cost for buying back a loan. So if that is in fact the case and the risk associated with that, then we are in a position where we can't originate down payment assistance loans until that risk is subsided.
Yeah.
So to answer your question about then what options does a first-time home buyer have, a first-time home buyer does have other options that can be explored through maybe family gifts. FHA allows for a gift from an employer. You can get gifts from friends if I can prove, lifelong friendships. Facebook does a wonderful job of doing that. So there are other options, and or credit repair plans and financial plans. Let's get the conversation started so that we can build a game plan and a timeline to get you into a home. Don't sit on the sidelines thinking, well, I don't know, or I don't want to get involved in the risk. Let's see what the risk really looks like for you, because as we were talking about, it's interesting. Everybody's getting caught up on the unemployment number and the jobless claims. I mean, it hit 10 million in the last 2 weeks, and that's big, but there are 162.7 million active workers right now. So 10 million of those, there's still a large number of people who are still actively engaged in the workforce. They're just working from home right now.
Yeah.
Yeah, absolutely.
Yeah.
And then I know you had also talked about, there's a lot of lenders that are changing the rules around FHA and VA, and some of them are not even doing FHA and VA loans anymore. And then also jumbo loans going away. And I know we talked a little bit about that as well. So if you can elaborate a little bit, that'd be great.
So the loans that are going away due to the risk, right? Because right now we have the risk is in the servicing. So really quickly, without going too deep into servicing, if I originate a loan, I have to think of a supply chain, right? Like a factory assembly line. And if I originate a loan way down here at the beginning of the assembly line, you're down here with me, right? You're getting buyers excited and you're showing them homes, and I'm originating a loan. We're at the very, very beginning of the assembly line. And then that loan has to go to a servicer who buys the servicing rights. And that loan gets insured by Fannie Mae or Freddie Mac. And then it goes to an investor. And then those investors pool that money and sell it to 401ks. And then it ends up back in our hands. So we're buying our own mortgages in the end because we have shares in 401ks and IRAs. Well, you have to think of the entire supply chain. If I don't have an investor, or if I don't have a servicer, or if I don't have an insurer for those loans, then I don't really have anything that I can sell. I don't really have anything that I can originate. So I have to look at this time right now and go, where am I weakest in the supply chain?
Yeah.
I'm weakest where I don't have major government backing, being jumbo loans, because those are not backed by Fannie Mae and Freddie Mac. They're backed by correspondent lenders and banks. So jumbo loans are a risk. Down payment assistance, because we talked about the buyback period, is a risk. Non-QM, which is the new age way of saying subprime, right? That was the bank statement loans and the rental income as assets loans and assets as income loans. Those are all at risk. So, and then portfolio loans, even we're seeing some small banks are not closing their doors. They're just not open to originating. And they're doing that because they're not insured, because they're worried about that supply chain as well. So really what we've done is we've narrowed the whole process to vanilla ice cream. That's all we got left, guys. Right? We're not living in the land of Baskin Robbins anymore. We're living in the land of vanilla. And maybe you get vanilla bean, but that's about the stretch of it, right? So in the land of vanilla, you've got Fannie Mae and Freddie Mac, which is operating almost relatively the same as it was before. And then you've got FHA, which has tightened. And the reason why it's tightened is because it had like 31 flavors of vanilla before. Like it might have been vanilla, but it was vanilla down to a 600 credit score, up to a 55 debt to income ratio, to a almost no money down with down payment assistance. So all of those were risks. So we've kind of chopped off the bottom and the top to get back down to here, which makes it look a lot like conventional. Mm-hmm. So now you've got most lenders, not all, most lenders are going back to a 640 to 680 credit score, a 45% debt to income ratio, standard loan to values, because they're getting rid of down payment assistance. So it's just starting to look a little bit more like conventional. Sure. And then of course we've got VA and USDA as well.
Do you expect the rules to maybe loosen a little bit after some of our life returns back to normal? Do you expect some things to start being more like what we saw before?
I do. Okay. Yes, that's a great question. And how long is it going to take? Because I don't know if you remember how long it took for jumbos to come back after 08. Yeah. Years. Yeah. Years. So it will come back, and they will come back in, it's almost like we're going to dip our toes back in the water. You know, let's bring this back. Now let's bring that back. I think in different forms. So yeah. I think jumbo will come back. Some of it might even come back within a couple weeks or a month. Some of it will take longer. When jumbo comes back, it will come back looking more like conventional. It will be 20% down. It will be more amounts in reserves required. It will be lower debt to income ratios. So it, you know, because I was starting to see 95% jumbos and high credits or low credit scores and high loan to values. Those are all gone.
Yeah.
Non-QM, I'm not 100% sure it'll ever come back. Or if it does, it will be years, and it'll be a third iteration of subprime.
Sure.
Down payment assistance will come back as soon as we realize if we have the investors. But again, I think the down payment assistance is going to have to abide by the tighter FHA box now. So it will just be smaller debt to income ratios and that kind of thing. So I think some of these will come back. Some of them will take a little bit longer. Subprime or non-QM, maybe not ever the way it looked before.
Yeah.
But I'm excited as they come back. But right now, I am an expert in vanilla. And really the cool thing is about, okay, so before we were super creative in all of the creative options we had.
Yeah.
Now we have to be more creative because you have to make vanilla taste really, really good.
Yeah.
And so how do I solve all these different pieces and give people options? Because like now, instead of jumbos, we're doing first and seconds, and we're doing a lot of them.
Yeah.
So there are options for a lot of clients. It's just knowing what those are.
Yeah, absolutely. No, thank you for always being positive about everything that's going on. It's always a breath of fresh air. So,
Absolutely.
yeah. So.
No, absolutely.
No, Nicole, you're awesome.
Yeah,
You've been
thank you.
great, and we love you as our business partner, our referral partner, and yeah, we love your team. So.
And we love you as a friend too. So.
Yeah, friends is first for sure.
Yes, friends are first. No, that's awesome. Yeah, no, anytime. I always love our time spent together. So thank you.
Thanks, Nicole.
Thanks a lot.
Yes.
Have a great
Bye-bye.
day.
Bye.